Good afternoon, everyone. This is Matt Young, Vice President for State Regulation and Legislation at the AICPA. I want to welcome you to today's webinar, where we're going to look at a whole host of issues from 2015, as well as what we expect to emerge in 2016. Before I get started, though, a couple of housekeeping notes. One is we're going to be recording today's webinar. So should any of your colleagues be unable to attend today's webinar, we will send that out at a later date, along with a copy of today's PowerPoint presentation. In addition, I want to draw your attention to the chat box on your screen. Should at any point you have questions about the topics that we are covering or want more information, please feel free to put a comment in the chat box. We'll try to answer questions, the Q&A box. We'll try to answer questions at the end of the presentation, and if we don't have time, we will try to follow up with you individually. We're very fortunate to have a number of folks participating in today's presentation. Let me start by introducing my staff. I think many of you know them quite well and work very closely with them, but if by chance any of you don't, then let me start by saying that I'll be joined by Suzanne Jolliker, who is our Senior Manager for State Regulation, James Cox, who is our Senior Manager for State Legislation, and also helping me put on today's webinar is Lindsay Patterson, our Manager for Communications, as well as Julia Morris, our Project Administrator. In addition to the members of my team, we also have three outside speakers who I'm very happy to say are joining us and will be able to offer a little outside color to some of the issues important to the profession. First up, we'll have Marty Green later in the presentation from the Illinois CPA Society, speaking about tax preparer registration and that issue in his state. John Johnson is going to be joining us from the National Association of State Boards of Accountancy, talking about the recent dental board decision at the Supreme Court. And also, I'm happy to say that Eileen Scher, a Senior Technical Manager from the AICPA's tax team, will be talking about the recently passed due dates issue and its impact on state tax policy. So with that said, let me go ahead and turn the issue over to James Cox and my team. I know most of you are all quite familiar with the Uniform Accountancy Act, but James, if you could talk a little bit about the UAA and then go into some of the issues that state societies and state boards have been working on over the past year. Thanks, James.
Thanks, Matt. As Matt mentioned, many of you are very familiar with the Uniform Accountancy Act. It's the profession's model state act, and it is very evergreen in that it is constantly updated to reflect changes within the profession. The UAA is developed and updated jointly by both AICPA and the National Association of State Boards of Accountancy. The most recent update was in 2014 and handled two issues: the comprehensive definition of a test and firm mobility. With regards to a test, the change closed a loophole that allowed unregulated non-CPAs to perform certain attest services. These services included XBRL and sustainability reports, as well as greenhouse gas emissions. Increasingly, cybersecurity is also one of the issues that unregulated non-CPAs were performing. 30 states now have the comprehensive definition of a test. This year, 8 states moved to adopt or to conform their statute to the UAA. Additionally, 2 more already had the comprehensive definition, but passed legislation to make needed conforming changes to their accountancy statutes. In 2016, we expect 8 to 12 states to move on the issue. As I mentioned, there were 2 issues that were updated within the 2014 edition of the UAA. The second pertains to firm mobility, which allows CPA firms to provide attest services across state lines under the no notice, no fee, no escape system. Firm mobility requires out-of-state firms to meet the same requirements as in-state firms, so peer review and firm ownership. Firm mobility is already in practice in 14 states, and we expect 4 or 5 to move in the coming year. I'd now like to turn it over to Eileen Scher to cover one of the important tax issues that Matt mentioned, and that is due dates legislation.
Hello, This is Eileen. I'm giving a brief update on what the federal tax due dates changes happened and how it could potentially affect some states. So just to give you an overview, back in July 31st, Congress passed, we actually got something past Congress, and the president signed the Highway Trust Fund bill. And hidden in there was a federal tax due dates change that the AICPA has been supporting for many years, and we were very happy that it was included. The reason we've been working on it is that a lot of taxpayers and practitioners were receiving the Schedule K-1s from partnerships showing their investment income for partners was coming about the same day or a few days before the individual and corporate due dates. And it really wasn't giving enough time to completely fill out the return accurately and timely. So with this new change, we'll start with the 2016 tax returns. So actually the 2017 filing season, it will not be this filing season. So we have a year before the changes happen. So that gives us a year to educate our members and to work with the states on any changes that may need to happen to coincide with the federal changes. I'll briefly go over the changes. The most important change is that partnerships will now will start having a March 15th filing deadline instead of April 15th. So they'll get in a little bit earlier so that the individuals and corporations that are partners in the partnerships will get their K-1s and have a month to deal with that. If any partnerships are having problems, they can still extend until September 15th. The current filing extension due date will stay the same. So partnerships will have until September 15th to extend like they do now. The corporations will move back a month. So they'll go from March 15th to April 15th. They'll get an additional month to work on their returns after they get the partnership K-1s. And possibly some corporations that have audits, if they're finishing up the end of March, beginning of April, they may no longer need to extend their tax returns and may actually get them done earlier. Speaking of the corporate extension, calendar year corporations have a little bit of a delay in postponing the September 15th filing extension for them. They will move eventually to October 15th filing extension, but that will be 10 years from now when it's outside the federal budget window, which everything gets measured with revenue within the 10-year budget window. So that little change with their corporate extension will stay September 15th until 2026, and then will eventually be October 15th. Individual and S-Corps did not change. Those deadlines stay the same. So there's no changes there. And just a few other changes, the FBAR, the Foreign Bank Account Reporting Form, which traditionally has been due on June 30th, will now move to the individual due date. So it'll now move till April 15th, and then can be extended, which is the first time it'll ever be allowed to be extended, until October 15th when the individuals are due. And that makes more sense because that's when the information about these people is available. So we thought that made more sense. Also, the 990 series will now just have to have one 6-month extension instead of two 3-month extensions. So we hopefully simplified things and made it go in a logical flow with the filing return process. As far as the state tax impact, some states currently automatically follow the federal due dates. So those probably do not need any legislative changes, but you might want to make sure with your states that if you're one of those automatic due dates, the same as federal, that it's still happening. Some states may require legislation in order to follow the federal due dates. So obviously you're going to probably need legislation in those states to make it coincide with the federal due dates. And some states may choose not to go along, that they don't want to move their due dates. But that's at least something to be considered amongst your state societies and tax committees within your state societies, whether or not you need legislation and want legislation. And if you do, then I guess to act on it. Now, I will note that some states already have different due dates from the federal, so they may not be interested in changing, but they may want to be interested in changing. So at least it's a consideration that probably should happen at the state societies. If they want to keep them or they want to change them now that the federal is changing. Also, just to consider, some of the states require legislation to change their rules, and some will just be a regulatory change, and the Department of Revenue will probably be working on regulations or form instruction changes throughout this year, providing guidance. And obviously, the state societies may want to be monitoring that kind of guidance and working with the state revenue departments if there's any things that you want to influence or be involved in. So you have a year over this next year before these changes actually happen. So it gives enough time for the states to work on legislation that may, or regulations that may be of interest. I will now turn it, and I just want to mention one other thing is that the AICPA has developed some charts. We have a chart of due dates that's at aicpa.org/due dates. And we also have a special Washington tax brief that's on this due dates change that's available on AICPA TV that you can take a look at. And also there was an October 19th CPA Insider that went out an email that has an article on due dates. I will now turn it over to James.
Another tax issue that is extremely relevant to the profession is the taxation of professional services. This is, it seems to be a perennial issue for the profession, with 19 states or jurisdictions looking at it in 2015. I'd like to kind of take a step back and note that there are currently only 3 states, Hawaii, New Mexico, and South Dakota, that levy a sales tax in some form on professional services. This year, the issue emerged in several forms. It was included in governor's budget proposals. It was also considered as standalone legislation. And then many states opted to study the issue as a part of a comprehensive tax reform. I'd like to highlight Louisiana for 1 second. Louisiana is currently studying the issue, and its tax study commission is being directed by one of their CPA lawmakers. I'd now like to turn it over to Matt Young to tee up the regulation of tax preparers.
Thanks, James. As I believe all of you are very well aware, the debate over how and whether to regulate tax preparers has received a significant amount of attention at the federal level over the last several years. And in fact, the IRS has been grappling with trying to come up with a program that is statutorily permissible and will work. And the AICPA has certainly been very involved in that conversation. But as the federal debate unravels or unfolds, I guess this may be a more accurate way to say, some lawmakers at the state level have wanted to step up and have debates within their own states about whether or not they need to take action as well. And already on the books, you have 4 states, California, Maryland, New York, and Oregon, which regulate tax preparers. But the thing that we should all be aware of is that the regulation of tax preparers, at least at the state level, poses a whole host of really serious problems for CPAs if they are potentially implemented. For example, what does this mean for mobility? And will CPAs be required to register in multiple states if they offer tax services across state lines? And what will this cost? And how will that regulatory burden be passed on to tax preparers? And then ultimately, would such a program even really be effective against the bad actors who the programs are designed to thwart? And so for these reasons and many others, in those states where there has been question about potentially implementing a regulatory regime for tax preparers, state societies and the AICPA have really wanted to make sure that policymakers are aware of the potential shortcomings and risks involved, particularly while there's uncertainty at the federal level. I mean, our hope would be that a federal regime would be put into place that makes a lot of sense, that works, and then there could be some sort of complementary way of looking at state-related issues, but not recreating the wheel, not having 55, if you consider the jurisdictions as well, 55 different tax preparer registration regimes in place. That just doesn't make sense for the way tax preparation is done and how tax practitioners operate around the country. Some of the activity that's occurred thus far this year is in New Jersey and Colorado. In New Jersey, there's a task force looking at this issue, trying to decide what actions, if any, are necessary in the coming years legislatively. And then in Colorado, interestingly, there was recently a report issued that recommended the Colorado state legislature not regulate state tax preparers, so there simply was no need. Now, to do a little bit of a deeper dive, because this issue is an interesting one, and it's one that I think is going to be getting increasing attention around the country, I wanted to give everybody sort of a firsthand insider view from Marty Green in Illinois about his experience working on this issue. So Marty, I'd like to turn it over to you, and then we'll turn it over to John Johnson to talk about the dental board decision. But Marty, go right ahead. Do we have Marty on the line here? Looks like we've got some technical issues. I apologize for that. So my apologies, Marty. We're not going to get to hear your insights, but I can give everybody a quick recap on what happened in Illinois. Illinois had actually set up a tax return preparation task force to look at this, and the Illinois Society of CPAs was extremely active in working on this issue and in making sure that the representation on that task force would be fair and really take into concerns the perspectives of the profession. Ultimately, the task force did not recommend creating a duplicative oversight regime, but instead voted 5-2 to vote to require that the federal P10 number should be in any proposal for tax preparation legislation. And so that's a very significant improvement because it doesn't create a second regime. It rather would ultimately, if implemented, piggyback off of what the IRS is looking to do. And so as they have gone through this process of working on the task force, and now that they have the affirmative 5-2 vote, it looks very likely that there will be potential legislation in 2016 to implement the recommendations. There is a minority viewpoint, which is principally pushed by representatives from such places as H&R Block, which looked at sort of a more comprehensive, more complicated tax repair regulation regime, and that fortunately was not successful and did not get significant traction in the report. One of the things that, and again, I apologize if we couldn't get Marty connected on the call. One of the things that Marty had also pointed out to me that I thought was really interesting for state societies to consider moving forward on this issue is that if you can get something like this, if an idea for a task force comes up in your state and you can get it killed, because this is an enormous amount of work for state societies to follow this process through and make sure that a positive outcome comes from any recommendations. And I'm sure our folks in New Jersey and Colorado would echo that sentiment. It really is a high-risk undertaking. You don't know what sort of recommendations are going to come out of it. But if you can't kill it, obviously then the next best thing is to be as intimately involved in every single step of the process, making sure that you have representatives or nominees that you help pick on any task force, because you want to make sure that a constructive report comes out. And so really, as states look at this issue, if you see momentum in this, so you have to sort of assess your politics in the state. Every state has a different sort of calculus on, is it better to let these things move forward, or is there a way to table it? But the debate's not going away. Actors such as H&R Block are very interested in this issue and have been involved. And we've actually previously, not this year, but in the years past, seen efforts to just implement bills. But it seems now a lot of the strategy on proponents of this idea is to move toward set up a task force, debate the issue, and then use that as momentum to move legislation down the road. So with that said, I'm going to switch gears here. We're going to talk a little bit about state boards and regulation. And state boards on the call, so we welcome them to this webinar. I'm going to turn over to Suzanne Joliker on my team to talk a little bit about, I'm sorry, I misspoke. I'm going to turn it over to John Johnson and talk about the North Carolina Board of Dental Examiners decision. So John, welcome.
Okay, Matt, thank you very much. As most of you know by now, the U.S. Supreme Court recently released its long-awaited ruling in the Federal Trade Commission case against the North Carolina State Board of Dental Examiners. To set the table on how we got to where we are today stems back to 2008 when the North Carolina Dental Board began sending letters to unlicensed teeth whitening providers ordering them to cease and desist from unauthorized practice of dentistry. The Federal Trade Commission reacted to the cease and desist letters by first investigating the dental board for restraining trade in violation of federal antitrust laws. And ultimately, the FTC determined that the dental board not only lacked the authority to issue cease and desist letters to non-licensees, but also concluded that states having boards controlled by market participants must demonstrate active supervision over those boards. The dental board challenged the FTC, first through an administrative law judge, then an appeal to the FTC itself before going through litany of courts, which was finally decided by the U.S. Supreme Court early this year on February 25th, actually. The outcome of this decision underscored the need for active state supervision over boards controlled by active market participants in order for those boards to continue to enjoy immunity under federal antitrust law. And as you might surmise, this could potentially not only add an additional layer of oversight to the regulatory process, but also, give pundits a platform to promote their agendas moving forward. As you can see from this next slide, state boards have presumed to be immune from federal antitrust laws so long as they were first established by law as state agencies, which is the case for all of our board vacancies. And their otherwise anti-competitive actions were clearly authorized by statutes. What the outcome of the Supreme Court decision in the dental case did was to add a third prong to licensing boards controlled by these active market participants, and that is active supervision by a neutral state entity must be present in order for the state board to invoke state action immunity from antitrust law. So far, we have seen a handful of states respond to the dental case decision. The first was Alabama. They, in fact, addressed the issue two different ways. First, through an executive order issued by Governor Bentley. And under this executive order, regulatory boards were explicitly granted the discretion to decide whether or not to use regulatory oversight office to review potential anti-competitive board actions, which is what we believe is an appropriate and measured approach to the Supreme Court decision. However, about 45 days later, during a special session, the Alabama legislature considered creation of a separate oversight office without specifying what actions would be submitted to the office or who would pay for these activities of the office. The next state to tackle the issue was Oklahoma through an executive order. And in this decision, based on guidance provided by the Oklahoma Attorney General, the governor issued an executive order setting forth not only non-rulemaking actions must be submitted to the Office of Attorney General to be reviewed and written analysis for possible violation of law. And then on the other end of the spectrum, in an advisory letter issued by Nebraska's Attorney General and an opinion issued by the California Attorney General, both of these Attorney Generals took the position that active supervision does not require state government to have the day-to-day involvement in board operations or in all board decisions at all, but only in those decisions that are anti-competitive nature or based on activity that is not clearly defined by statute. As I mentioned at the onset, as you will see in this next slide, the outcome of the dental case of the Supreme Court decision certainly will give others a platform to drive their agendas. And in response to the California Attorney General opinion, the Center for Public Interest Law, which is housed at the University of San Diego, not only took exception to the Attorney General's opinion, as you will see in this next slide once it's brought up, but also took a jab at the accounting profession when they included this example as an anti-competitive action by a California regulatory board by stating that although the California Board of Accountancy continues to administer the uniform CPA exam as a requirement to becoming a licensed CPA in California, that exam is controlled by the AICPA, a trade association completely dominated by market participants. So as you can see, based on how states have responded so far to the Supreme Court decision and how certainly some pundits are beginning to respond also, we will certainly have our hands full in 2016 as governors, attorney generals, and the legislatures work through the hurdles this ruling raises as they attempt to implement the appropriate regulatory oversight structure in response to this Supreme Court decision. And to better prepare the profession to tackle this issue in 2016, NASBA will be conducting an hour-long webinar devoted to this issue on December 10th at 3 p.m. Eastern Standard Time. And during this webinar, we will be addressing the issues listed on this slide, and we'll certainly have plenty of room to answer questions posed by participants. So keep a lookout for an email from NASBA within the next few weeks on how you can participate. And I will, at this time, turn it back over to you, Matt, for the next topic, which is the code of conduct.
Well, this is Suzanne Joliker, and the next topic is the AICPA Code of Conduct. Over the past 2 years, the AICPA has been working with NASBA to encourage state boards of accountancy to adopt the Code of Conduct. We want to congratulate New Jersey for becoming the 19th state to adopt the code and acknowledge Illinois because they currently have a rule set that is out for public comment that also adopts the Code of Conduct. Without uniform ethical standards, it's difficult for CPAs to practice across state lines. Variations in ethical standards are confusing to CPAs, and they are also costly, and those costs are passed along to clients. Uniform standards actually make it easier for CPAs to comply with state regulations, thereby protecting the public interest, and it also is a sound business practice. Another benefit of a state adopting the Code of Conduct is the conceptual framework, which is not found in state regulations. Under the conceptual framework, it gives direction to CPAs when there is no established guidance in an area. It helps CPAs to identify, evaluate, and address threats to compliance with ethical standards. The conceptual framework is also important because it is impossible for state boards to promulgate regulations in every ethical area that might come up, a CPA might come up against. We anticipate that state boards and state societies will continue to discuss adopting the Code of Conduct, and we expect 5 to 6 states to adopt it in the coming year. Another joint initiative between the AICPA and NASBA, we are encouraging state boards to adopt CPE reciprocity. Although the UAA model rules have contained a CPE reciprocity provision for many years, less than half of the jurisdictions have adopted the provision. Under the model rules, CPAs who are licensed in multiple states do not need to comply with each state's CPE requirements. They only need to comply with the CPE requirements of their home state. However, if the CPA is from a state that does not require continuing professional education, the CPA must follow the CPE requirements in each state in which they are licensed. Recently, we've discovered that some state boards and some state societies are under the impression that CPE reciprocity provisions are no longer relevant because of mobility. And that is not the case because some CPAs have chosen or are required to maintain multiple state licenses in spite of mobility. These same CPAs are then faced with a myriad of state-specific requirements, such as state-specific ethics, mandatory accounting and auditing hours, or restrictions on the number of self-study hours they can earn. CPE reciprocity encourages uniformity while removing unnecessary burdens that don't protect the public interest. As with the Code of Conduct, we expect a number of state boards will be discussing the issue during 2016. The state regulation and legislation team has a number of resources concerning the Code of Conduct and CPE reciprocity available on our website and on Capitol. At this point, I'd like to turn the program back over to James.
Thanks, Suzanne. Increasingly, the CPA profession is being threatened by a variety of groups from outside of our sphere. One of the issues that I would like to kind of tackle first off is called ban the box. And ban the box proposals prohibit employers from asking about an applicant's criminal background on an application. Put simply, these proposals would require employers to remove the checkbox on an application where an applicant has to identify themselves as having a criminal background. While this concept is great in nature, in form, it has met criticism by many in the business community and poses unique challenges for CPAs and CPA firms due to the handling of sensitive materials. In 2015, 24 states considered ban the box proposals. Oregon was one of the states that enacted a restriction on employers. Additionally, governors in both Georgia and Virginia issued executive orders pertaining to state government. However, those executive orders included exemption language. And should your state move towards or is considering such a proposal, we would ask that you seek exemptions for both CPAs and CPA firms. I'd like to note that the AICPA state regulation and legislation team has a multitude of resources on this issue should you need them. An additional employment issue addresses both sick leave and schedules without the consideration for salaried employees. And unlike ban the box, which has most recently been at the state level, these municipal laws are focused at the local level. So it's extremely important to pay attention to what large cities are doing in your state and then seek exemptions in such proposals for salaried employees. I'd now like to turn it over to Matt Young, who will be discussing marijuana and the profession.
Thanks, James. I'd like to take a minute here to talk a little bit about probably one of the more interesting issues facing the profession. And I know that I've had a chance to talk to many of you about this as it becomes a more complicated and a more salient issue. As all of you know, federal drug policy prohibits the sale, the use of marijuana everywhere in the country. However, a number of states, starting with California in the early 90s, have legalized medical marijuana. And of course, the big game changer that occurred in this country on marijuana policy about 4 years ago was the legalization of recreational marijuana in Colorado and in Washington state. That was followed then 2 years later by successful ballot initiatives in Alaska and Oregon. And so we're in this dynamic now where it is completely and still illegal to possess or sell marijuana all across the country under federal law, but states are not only removing their prohibitions, but setting up legal and regulatory frameworks that involve the sale, the production, the sale, and the taxation of marijuana. And so how does that work in practice versus reality versus theory is a real challenge. And one of the things the AICPA has done, we did this initially in partnership with the Washington Society of CPAs as well as the Colorado Society, was to put up together a white paper. that looks at what's happened, how the law has evolved, and questions that CPAs need to ask themselves before undertaking such work. We certainly are not in a position, nor would we ever be in a position, to offer any sort of legal advice, but we can at least present the information as we know it and give practitioners a chance to make a more informed decision. If any of you haven't had a chance to check out our white paper, it's available at aicpa.org/marijuana. As things have moved forward across the country, a handful of state boards have begun to look at this issue, and I really want to commend them because they have taken a very thoughtful and cautious approach to what would be an appropriate statement on this. And I think that's warranted because we're going through a period of significant change. And what many boards have basically said is that they don't opine on federal law because that's not necessarily appropriate for a state agency to speak to federal law, but they do say that if you are complying with the laws in our state, we will not consider this an act discreditable, and we won't take any action against you unless you are subject to some sort of other criminal enforcement action. And so I really think, my personal opinion, I'm not speaking for the Institute, but my personal opinion is that's the right place to be, that this policy is going to evolve quite a bit, and what makes sense today may not make sense a year from now. And let me just fast forward everybody to next November, because if you haven't heard, while there are now about half the country, as you can see on the map, who have legal medical marijuana laws on the books, and only 4 that have recreational, we expect, based on our tracking of state legislation and ballot initiatives, that anywhere between 8 to a dozen more states will consider the question of recreational marijuana and medical marijuana in November of 2016. Now, if you consider even just a couple of those, a handful of those, or to legalize recreational marijuana, and say that some of them are big states, a place like California, for example, we could very well end up in a regime where a quarter, maybe even a third of Americans live in a state where marijuana is legal at the recreational level, but remains illegal at the federal level. And how do we resolve that? What does that mean for law enforcement, for the Department of Justice, where DOJ knows that they don't have the resources to enforce the law in all of these states, and people know that they won't be, probably are very unlikely to be prosecuted for violations of these laws? It's going to be a really interesting and complicated debate, really, as lawmakers take office, I would say, in early 2017. So I just want to highlight that for folks, that the next 12 to 15 months will be a really interesting time, and irrespective of if more boards take positions or not, everyone, not just the CPA profession, the lawyers, anyone who provides any sort of services, realtors, other services providers, are going to have to think long and hard about what this means as this potential market continues to grow and grow. With that said, I'm going to change gears now. And one of the things we've talked a lot about on this webinar, and I really feel fortunate, is that we work so closely with NASBA, and I'm so glad that John was able to come and talk about the work that NASBA was doing in light of the dental board decision. One of the ways that we do collaborate very closely is on our work on the UAA committee. And if you're not familiar with the work of the committee, there are volunteers, 10 from the AICPA and 10 from NASBA, that review the UAA and try to make sure that it's evergreen and up to date. And so next year, we're going to be doing a number of things. One is, there's been a lot of talk, perhaps many of you have heard this at NASBA conferences or at some of the AICPA meetings, about potentially creating an international pathway for foreign credential holders who wish to become U.S. CPAs. And this would be a slight deviation from the mutual recognition agreements of the past. Those will stay, and we'll continue to renew them. But this would allow essentially a unilateral pathway. And so our hope is that the UAA committee will consider that language in early 2016, and then put that idea out for public comment and exposure. And we can really get some constructive feedback from stakeholders about the path that we are looking at going down. Other topics that the AICPA and NASBA leadership have approved for discussion are CPE model rules. Many of you may be aware that the CPE standards have been going through an exposure process and debate. And as part of that process, we'll ultimately need to adopt, or at least put out into put out to stakeholders model rules on CPE. So that will be coming down the pipeline, as well as looking at the exam, education, and peer review components of the UAA, because we just want to, from time to time, look at them and make sure that they're timely, and then they reflect the way in which CPAs operate, and that the language does protect the public the way we want it to. And so I look for some really interesting constructive progress from the UAA committee, NASBA and AICPA working together on that in the coming year. One area where we already have a proposal out for exposure, and I wanted to draw this to everyone's attention on the webinar today, is on the status of retired CPAs. This has been a debate that we've had for several years, and a number of folks are very interested in this, whereby the states, I have to say, have gotten a little ahead of the UAA when, in the absence of a solution, it's not surprising when states come up with their own. But we came to a point among AICPA and NASBA leadership, as well as our volunteers, where we said we really ought to have a uniform retired CPA status. And so the committee made a recommendation. It went out to the AICPA Council, which lent it its support, as well as to the AICPA and NASBA boards of directors. And what the proposal says is that we would allow the creation of a retired CPA status for CPAs over the age of 55 who want to engage in a limited array of volunteer uncompensated services. That's volunteer uncompensated services. And what's being proposed right now are three things. You would be able to, as a registered retired CPA with your Board of Accountancy, to offer volunteer tax preparation services. You'd be able to participate in a government-sponsored business mentoring program, such as the SCORE program at the Small Business Administration. And within your community, you could serve on the board of a nonprofit organization. Now, by virtue of being able to do these things under this retired CPA status, there are some important public protections that we've put in place that are also out as part of this package. One is that whatever you do while identifying yourself as a retired CPA, you would have to remain subject to the rules of your state board and its oversight. Two, in order to transition from being an active CPA to a retired CPA, you could not have had your license revoked or suspended or be under any sort of other reprimand before your board or any other board. And then finally, while there would not be a specific CPE requirement for retired CPAs, you would have an obligation to remain competent in the areas in which you are volunteering your services. Now, we are hoping for a very robust comment period, and we would really welcome feedback from state societies and state boards and other stakeholders about, did we get this right? Is the scope make sense? Are there suggested changes? And the comment period has already started. It will run through February 2nd of next year. And if anyone wants to submit comments, they can certainly do it to the AICPA and NASBA. And there's information on that at aicpa.org/states. So with that said, that takes us to the end of our webinar. Again, I want to thank all of our speakers who were able to join us and offer their insights. As I mentioned at the beginning of the webinar, we are going to make this presentation available, this recording available at a later date, complete with a copy of the PowerPoint, so that if those who were not able to call in for this particular time will be able to do so at a later date. You're also welcome to use any of the information here within the PowerPoint. Feel free to contact Lindsay Patterson. She'll be the one sending out sending out the link to the recorded version of this, and she can walk you through any questions about permission on reuse and so forth. So looking at the Q&A box, it does not appear that we have any questions at the moment. So again, I want to thank you for taking some time out of your very busy schedule to look at our end-of-year review, taking a look at all the major accomplishments of the last year and what we're anticipating for next year. I think the profession has a lot to be proud of. We've all worked very closely together on a number of major initiatives. There's a lot of improvement on UAA conformity and on also tackling head-on some tough challenges the profession is facing from a whole host of different places. And we seem to inch forward and make progress every year. So I want to thank you. And as I mentioned before, if at any point you have questions about resources or other materials that we can help you with, like I said, we work very closely all across the country with all of you and with NASBA, and we're happy to help. So with that, have a fantastic afternoon, and we hope to talk to you guys soon.